In this video, I'm going to show you the tax effects in terms of financial reporting for a restricted stock award. When a company compensates one of its executives with a restricted stock award, it often creates a book tax difference. And that's because the financial reporting rules for a restricted stock award say that that award should be expensed at the fair value of the shares as of the grant date over the vesting period of those shares. Okay, so you look at the grant date, that's when the board of directors says, okay, we're going to give the CEO 50,000 shares. Okay, you look at the stock price as of that date, that's the total fair value, and you divide it by the vesting period. So if it took 4 years for the shares to vest, you would take the total fair value, divide it by 4, and then just expense that evenly throughout the vesting period. Now, in terms of taxes, we can have a difference. Now, it depends on what country you're in, but in the United States, here's how the tax rules work. Okay, on the tax return, a company is not going to get a tax deduction until the restricted shares have actually vested. Okay, and at that point, they're going to get to deduct the fair value of the shares as of the vesting date. Not the grant date fair value, the vesting date fair value. So basically, you have a situation where for financial reporting, the company is recording expenses throughout the vesting period, but then they don't get a tax deduction until a later point in time when the shares have actually vested. So they have a book expense first and then later a tax expense. So it's a situation where you have a postponed tax deduction. And so in the future, because of this temporary book tax difference, in the future, taxable income will be lower relative to book income. Okay, because later it's like up front they're expensing this for financial reporting but not getting the tax deduction. Later they'll get the tax deduction after they have fully expensed this thing for financial reporting. So it's just a timing difference, and that's going to result in a deferred tax asset. So I want to show you the journal entries with an example, and so you can see how this would work. Okay, so let's say we've got a company that grants 40,000 common shares to its CEO on January 1st, 2024. But this is going to be a restricted stock award, RSA. Okay, so they're not going to get to, they can't just turn around and sell the shares immediately. The CEO can't give the shares away or sell them on January 1st, 2024. There's going to be a restriction period of 2 years. So they have to still be employed with the company January 1st, 2026. So if they get fired or quit before then, they're going to forfeit the shares. So we've got the stock price on the grant date, January 1st, 2024. This is the grant date. $7 a share stock price. We're going to use that to calculate the amount of expense for financial reporting. We've got a par value of $1 a share, and then the company's tax rate is 25%. Now, the fair value on the vesting date is going to be $9 a share, but we don't know that yet when we're doing the journal entries for financial reporting, right? So that's going to come in at the end, and that's going to affect the actual tax deduction. So let's do the end of year one, and there's a way where you can make a journal entry on the grant date. I'm not going to do that approach. I'm going to do the approach where you make the first journal entry at the end of first year of the vesting period. Okay, so we had, if I can just make sure you see that there, 40,000 shares, $7 a share, fair value on the grant date. So the total amount, the total fair value of this restricted stock as of the grant date is $280,000. That's just 7 times 40,000, right? So let me write that out. So 7 times 40,000 is 280,000. But you don't expense 280,000. What you're going to do, you're going to divide that by the vesting period. It's a 2-year vesting period. So what they're going to do is they're going to record $140,000 of expense each year of the like in year 1, year 2, and you're going to credit this equity account called paid-in capital restricted stocks. That's a stockholder's equity account. So you're recording an expense, you're crediting an equity account. Now, I've made other videos where I did this before, but I always told you to ignore the tax effects. Well, we're going to have a deferred tax asset here, and the reason is that we're reporting this expense on the income statement for financial reporting, but the company's not getting a tax deduction for that yet. So the tax deduction will come later, right, when this vests. So what we're going to do to calculate the amount of the deferred tax asset, we're going to take 25% of that compensation expense. So 25% times the $140,000 expense, okay, and that comes out to $35,000. So that's going to be the amount of the deferred tax asset, $35,000. What we're going to credit is we're going to credit income tax expense. Okay, so this is effectively reducing the income tax expense on the income statement for the company. We're going to make the exact same journal entry year 2. Okay, so we're going to debit and credit the same account. So I'm just going to write in here the same numbers, and we calculate it the same way. Basically, grant date fair value was $280,000 with the shares, but you divide by 2-year vesting period, so it's $140,000. So that's that amount right there, and then right here. Okay, and then again, 25% of that, because I said there was a 25% tax rate. If it was the 30% tax rate, then you multiply 140,000 by 30%. Okay, so those same journal entries, year 1 and year 2. Now, when it gets to the vesting, now things are going to change up. Things are going to change up, and we're actually going to have, I've broken it into 2 sets of journal entries here. And the first is the actual vesting of so where they're no longer restricted shares, what we got to do is we got to debit paid in capital restricted stock. We credited it twice for $140,000. If you go back, we credit it twice for $140,000. So to get rid of it, because it's no longer restricted shares, right now it's fully vested, we're going to debit it for $280,000 because it was credited twice for $140,000, so it had credit balance of $280,000. So this is going to be the zero out. Why are we debiting this? Well, the stock is no longer restricted. Now it's just regular shares. So now we're going to credit common stock and additional paid-in capital. Now, common stock, I told you before, the par value was $1 a share, and there was 40,000 shares. So this is going to be 40,000. And again, I'm just going to write, so there was 40,000 restricted shares that are now unrestricted times $1 par per share. So that's where we get that. And then the additional paid-in capital is just be our plug, is $240,000 to make that journal entry balance. Okay? So we're getting rid of that paid-in capital restricted stock account. That's an equity account, and then we're crediting these other equity accounts. Okay, so we're just reclassifying this. Instead of restricted shares, now it's just regular plain old common shares. But we got to get rid of that deferred tax asset. Remember that, right? Because now the company's going to get a tax deduction. So we debited the deferred tax asset twice for $35,000. So we're going to need to debit that to credit it to get rid of it, right? We debited it twice for $35,000, so it's got a debit balance of $70,000. So we're going to credit it for $70,000. Now, you see I've got other accounts up here. I got income tax payable and income tax expense. So income tax payable, you think about like the actual amount. This is a liability account, balance sheet account, affecting essentially like how much are they going to have to pay to the government. Well, I've got this being debited, which is being reduced. Why is it being reduced? Well, now, January 1st, 2026, this thing is going to be tax deductible because now it's the vesting date. This is vested, so they're going to be able to get a deduction. But now you might be thinking, well, how much is it going to save the company? Is it going to save them to $70,000? No, because remember, there were 40,000 shares, but now the vesting date stock price is what is used to determine the amount of the deduction. So this is now $360,000 is the amount of the deduction, right? It's not 40,000 times 7. 40,000 times 7 is used to calculate the compensation expense. But now the vesting date fair value is different. Turns out it's a little higher, right? So you're going to get a bigger deduction than what, relative to what the vesting date thing had been. So now, how much is a $360,000 deduction worth? Well, the deduction's worth the amount of the deduction times the tax rate. So 25% tax rate. So this is going to be $90,000. So we're actually going, in other words, if you're wondering, hey, what is this $90,000? What does this signify? It's saying, look, January 1st, 2026, when this thing's vests, they're going to get a $360,000 tax deduction. They got a tax rate of 25%, so that's going to save them $90,000 of taxes. In other words, in that year, the taxes payable to the government are going to go down by $90,000 because this is a liability. When you debit a liability, you're reducing it. So reducing the amount of taxes paid for that year by $90,000. So we got rid of the deferred tax asset because the temporary difference has now been resolved, right? So that needs to be zeroed out. We zeroed it out. And now we reduce the tax payable by $90,000. But then you say, hey, wait a minute. We still need a credit to make this thing balance. And we credit it for income tax expense for $20,000. Why are we crediting income tax expense? Because it turned out this deduction, relative to up front, when they originally granted this thing, the share price was $7 a share. But then it turned out later the share price went up. It went up to $9 a share. So actually the deduction turned out to be higher. So higher deduction, less tax expense.